Hey, what's up, everybody? Welcome back to Investing Sucks. So, in this video, we're going to be doing an update video on EQB Stock. This is a company that is currently one of my largest holdings and is a company that I have talked about previously on this channel. And this is going to be a once in a while style of video where I do talk about my personal portfolio and what I'm buying or selling, what companies I'm looking at, because I do get questions a lot in emails of people asking me those questions. What companies am I looking at? What investments have I made recently? What do I think of some current event that's happening? And I really don't plan on doing these videos all that often just because I do get the sense that discussing my portfolio openly on YouTube is kind of dangerous, not just for myself, but also for other people who watch me. And I really want to avoid having people just copy whatever investments I make, thinking that because I'm the guy on YouTube, I must be super knowledgeable and have all the answers to all the investing questions. But honestly, guys, I'm just trying to figure out this stuff just like you. And I can come on here and say that this is not financial advice. I'm not a financial advisor all I want, but the truth is, with a large enough viewership base, even of only a few thousand subscribers, people are going to take what I say as financial advice and they are going to make decisions based off of the information that I provide. But at the same time, I do think it's important to be transparent with my audience and discuss what I'm doing so you guys can judge for yourselves if I actually practice what I preach. Because it's very easy for me to come on this channel and say, you should do this, you shouldn't do this. But if you guys can see through my own personal investing that I'm not following those principles, then do my words carry any weight? Probably not. So it is a fine line that I'm trying to walk here. And like I said, I'm still trying to figure things out. And for me, I think the best approach to do is to discuss my own investments, but do so very sparingly. Okay, so on to EQB. So what I want to do in this video is a few things. One, I want to quickly go over the main points that I covered in my initial video here, and then talk about what has changed for this company since this video was posted. And then I also want to talk about if my thesis or my stance on the company overall has changed since then. So this is the original analysis that I did on EQB. You can see it was posted January 31st, 2022. And some of the main points that I made in this video were number one, that EQB doesn't really compete with the big banks of Canada because majority of the loans that they offer are fundamentally different, specifically with respect to alternative lending, which we'll get into in this video. And two, they are very, very exposed to the Canadian real estate market, which is where the vast majority of their loan originations come from. So at the time I made this video, I was also buying the stock, and my cost basis on EQB is currently in the high 60s per share, which means I'm currently down around 30% on this one. So has my thesis in the company changed at all? The answer is yes, but only in the short term. My long-term view on the company still remains unchanged because in the short term, there have been developments taking place over the past few months, which should materially impact the business in the short term. However, like I said, my long term view in the company is unchanged, and the trends that I see playing out in this industry and for EQB don't really seem to have changed in the past few months, which I'll get into that in this video. So one of the key metrics I like to use to determine the overall sentiment around a bank stock specifically is the price to book ratio. So we can see currently for EQB, it's 0.83, which means their book value is currently higher than their market cap, which is low compared to what it has been historically. We can see this is looking about 7 years back. The mean or the average is just over 1.12, and it's currently at 0.8. So what we can infer this to mean is that investors are concerned about EQB's risk exposures and they are anticipating losses in the future. And they think that with the weakness in the economy that we've seen develop over the past few quarters, that could spell trouble for EQB down the road if customers start defaulting on existing loans they have, and they have a harder time originating new loans, which slows growth in interest revenue and leads to less profitability overall for the bank. And what you have to keep in mind is when you invest in a bank in general, it's really a vote of confidence for the health of that country's economy, more so the long term health than the short term health. Because in a growing economy, you need that for them to do well, because a growing economy is one where new businesses are being started, people are buying homes, so demand for credit is high, and people are also making money, so they're not defaulting on those loans. And the bank is collecting their interest revenue, which is what you want to see as a shareholder of a bank. And the banking business model, you can really think of it like a risk balancing act because they make money off of number one, interest, like I said. So the difference between what they pay in interest to their deposit holders and what they earn on interest and the loans they make. And then number two, they also make money in non-interest income, which consists of various investments they make in bonds. They can also make investments in equities and earn dividends from that. They also make strategic investments in other companies, which is something EQB does. And they also earn a little bit in fees off of the various accounts that they offer. But it's a balancing act because for them to make money, they don't want to take on so much risk where their loan losses are high, but they also don't want to take on so little risk that they're not making very much money in the form of interest revenue. Now, banks can be pretty complicated and pretty confusing to analyze. It's very easy to get lost in all the disclosures they have, but I like to keep things simple and I like to pick just a couple of key performance metrics that I can monitor on a quarter over quarter, year over year basis to keep my fingers on the pulse of the company. And with EQB, there are three metrics I use, which are number one, which I think is the most important one, and that is gross loans. So the total amount of loans they have outstanding. Number two would be net interest margin. So, really, how profitable are those loans that they're making? And then also return on equity, which looks at net income and book value, which are both important in their own right. In my opinion, if you focus on those three things, that's going to tell you 90% of what is going on with a bank and specifically with EQB. Because when you look at those metrics, they lead you down the right path. They lead you to ask the right questions about what's going on, why is this metric going up or down, what goes into the calculation, and it really helps you understand the company fundamentally. So to show you what I mean, I'll do that with EQB right now. So I'll start with an easy one, which is return on equity. This is just net income divided by the company's book value. And for a bank, you typically want to see this in the high teens. And we can see for EQB in the most recent quarter, Q2, which is as of the end of June 2022, it was quite low, 11.6, especially compared to what it has been historically, which is kind of in the mid-teens, right? That sweet spot that you want to see between 16 and 18%. And the reason it was so low for this quarter, if we take a look at their non-interest income, was because their non-interest income was quite low. It was actually negative. And the reason is because of these drawdowns that we've seen in the value of their investments. We can see they booked this loss here on investments and then also a similar loss on strategic investments, which I talked about before. They did have some fees which offset this a bit, but overall it was very large losses, which led to a negative number for non-interest income. So the reason this happens is because of the accounting that works for investments. You have to revalue your investments at their fair market value every reporting period, which means if they've lost value relative to the previous quarter, then you have to record that as a loss on your income statement and write down the value of those investments. Even if the loss may be just temporary, even if it's possible that it could recover in the future, you do have to always value it at the fair market value. So even though this obviously it's not a positive thing, I wouldn't necessarily take it as a super negative thing. And I don't necessarily think that this return on equity is something that's going to stay recurring into the long term. I think it's really just changing with the gyrations of the market. Okay, so next let's look at gross loans. This is one that's going to carry a lot of weight for this company because loans are really what this company's product is. Now, we saw previously that EQB was priced below their current book value, which means investors are anticipating more losses in the future. And this can happen in a number of ways, and one of them is if people stop paying back their loans, and the risk of this happening heightens during a recession. Now, the biggest takeaway here, which I mentioned previously, is that EQB is very tied to Canada's housing market. And if we look at the recent interest rate hikes that we've seen by the Bank of Canada, where policy rate has gotten to 3.25%, and it has risen very, very rapidly in the recent months of 2022, this is going to make financing the purchase of a home much more costly and is going to lead to lower loan originations. And because of that, lower interest revenue growth into the future. And this is not something that could happen or is debated whether or not it will happen. It is something that is going to happen because it's a fundamental law of credit markets. When interest rates go up, demand for credit goes down. So if we take a look at their current loan book, we can see here 16.3 billion of their personal loans, total personal loans of 24 billion, are alternative mortgages for single family residential homes. So alternative mortgages are designed for people who can't get mortgages from the big banks. So these tend to be people with lower credit scores, maybe a lack of an income history, people that are self-employed, people that recently immigrated to Canada, and various other examples. And another major loan category that we can see here is prime mortgages, so 7.2 billion. So this would likely compete with the big banks. And then if we take a look at the commercial banking side, they have 12 billion in total commercial loans, and about 5 billion of that is to multi-unit insured real estate mortgages. So clearly they live and die with Canada's housing market. And the issue with that is Canada's housing market is showing signs of weakness, which is likely why this stock sold off so much recently. Because if there is weakness in Canada's real estate market and EQB is very exposed to it, then that could lead to losses for them. But of course, that's something that's going to develop in the coming quarters. So it's something that we will monitor. And one good way to get an idea of what that could look like, or somewhat of a leading indicator, is to look at this report that gets published by the Ontario Real Estate Association, where they're basically talking about some high level summary statistics about home sales in Ontario. Now, EQB doesn't operate only in Ontario, but Ontario is where a good chunk of their loans are. So this will be very telling for their loan portfolio as a whole. And we can see that here they're saying residential sales activity in terms of units is down sharply from September of 2021. So they're doing a year over year comparison. 37.7%. And then home sales were 31.5% below the 5-year average, and then about 30% below the 10-year average for the month of September. Specifically, I take it they're talking about units again, but then talking about actual housing prices. The average price of a resale residential home across the province for September 2022, $800,000, which is a decrease of about 6% from September of last year. So all this data here may seem somewhat dire, but remember the year over year that this is being compared to was the peak mania of the housing market, where there was quantitative easing and rock bottom interest rates. And I'm not invested in EQB because of what I think is going to happen on a year over year basis, because that is very difficult to predict. What I'm invested in them for is what I see happening decades out. And remember before what I said about alternative mortgages being their biggest moneymaker, and it's not a product that the other big banks offer, hence the name alternative mortgages. And it is something, if we look at the data, that is growing in popularity. We can see this chart here where they're talking about alternative lenders and their market share of mortgage transactions in Ontario. And looking at some high level data, alternative lender portfolio increased from an estimated 9 billion in 2015 to 15 billion in 2020, which made it the fastest growing category of mortgage transactions. And if we look at their market share of those mortgage transactions, we can see an upward trend. It is going through some cycles where it's down certain years and up, but overall we can see an upward trend where they've been gaining more market share in this category, and EQB is one of the few banks in Canada that offers these types of mortgages, and it's one of the first options that people tend to look at. So the question is, why is this happening? Well, good thing they also point out some of the reasons why this may be happening. So they talk about this point here, a lower interest rate environment, which I think is just general for mortgages as a whole. Lower interest rate means financing a mortgage is a lot cheaper, so more people are able to do it. Rising housing prices. So as housing prices go up, demand for alternative lending is going to increase, because people, if their incomes aren't rising in conjunction with those housing prices, it's going to make it harder and harder to qualify as a prime lender and to be able to get access to the mortgages from the big banks. So people are forced to basically go with alternative lenders like EQB. And then they also talk about regulatory changes. So basically, as the guidelines and the regulations that the big banks have to meet in terms of capital and who they're allowed to lend to, as that becomes increasingly strict, then more people again are forced to move to alternative mortgages. If regulations around, income approval and what you're allowed to qualify when you're getting for a mortgage, as that becomes more strict, then like I said, more people have to go to alternative mortgages. Now, obviously, this is somewhat of a contrarian viewpoint, because the fact that the stock has sold off so much recently proves that maybe the majority of the investing public disagree with what I'm saying. But I do also think that in the short term, as rates rise and banks are forced to recalibrate to this new level of riskiness inherent in higher rates, alternative lenders will face headwinds as their loans become more expensive. And this article here, this was posted in July of this year, and it's basically just gathering opinions from various industry experts in this space and kind of summarizing them into talking about what they think is going to happen in the future. And they start by talking about the demand for alternative lending. And they're saying here, demand for alternative lending is through the roof as the stress test becomes an ever tougher hurdle for those applying for conventional lending products. Borrowers have turned to the alt space, and the demand for non-bank financing has significantly increased in the last 6 months. But then the other side of that, like I said, is the rising rates, which makes these loans much more risky compared to these conventional lending products, they're saying. And they go on to say here, over the last 5 years, the alternative lending industry has experienced some of the lowest losses in history, with rising interest rates and real estate markets with less demand, we can expect to see a normalization of losses, which will over time place upward pressure on interest rates that alternative lenders offer. So what they're referring to here is really just impaired loans, and we can take a look at the MD&A to get an idea of what impaired loans have been like for EQB specifically. These basically represent loans that the bank knows they have the information to tell that these loans probably aren't going to be collected. So if what they're saying is true, then what we're going to see in the coming quarters is impaired loans increasing because it says there's more people that can't afford the higher rates associated with these lending products. So more people are going into default, so impaired loans are increasing. Now, maybe this hasn't really played out yet. It will be very telling to see what happens in their next quarter, which should be coming up soon in the next month once they release results for that. But at least as of their most recent quarter, which is the end of June of this year, you can see that their impaired loans actually went down. We can see here it went from about 74.5 to 64.8. So it did decrease, but again, that's just quarter over quarter. What they're saying is that you're probably going to see this increase well into the future. Even if this recession does end up happening, then yes, you're going to see this increase. But overall, it seems like, at least from what they've reported so far, that these impaired loans have been pretty contained. But again, this isn't really a leading indicator. This is something that's going to happen in response to deterioration of economic conditions and in response to the rising interest rates that we're likely going to see continue happen. So, like I said, this is something to monitor, not really a leading indicator, but definitely something to keep an eye on. Now, another point I want to quickly touch on is immigration. Immigration policy in Canada is something that currently has bipartisan support. And the reason being is Canada's birth rate has been declining for several decades now and is nowhere near the replacement level it needs to be at. So, the only way the population of Canada is going to continue to grow is through immigration policy. And governments are very concerned by this because a declining population makes achieving economic growth very difficult, and immigrants do face unique challenges when getting mortgages from Canadian banks. And EQB did state in their annual report that they are a top choice for new immigrants. And this goes back to what I was saying before about the longer term trends being favorable for EQB because they are a direct beneficiary of this country's immigration policy, which is something that I think will end up being very favorable for them because we can see here the target that Canada has for immigration is increasing in the future years. About 450,000 in 2023 and then 451,000 in 2024. And because I don't really see any change happening with respect to the birth rate, Canada's population growing organically, I think immigration policy is the only tool Canada has to really help their economic growth, because productivity growth is something that can also help economic growth, but that is something that is more difficult to rely on, whereas immigration policy is something you can directly influence as a government. So this is, again, a long-term trend that I see playing out rather favorably, and EQB being a direct beneficiary of it. Okay, and the last of the three key metrics to look at is net interest margin. So luckily, this company has a disclosure where they talk about net interest margin, and we can see what it is here, 1.8%, which this is down slightly from 1.86% in the previous quarter. This may seem very, very small, but even little fluctuations like that can actually impact the bank's profitability quite significantly. And if we scroll down further, they provide a reconciliation as to why it changed the way they did. So they split out the reconciliation into the basis point impact. So they could say that it increased by 19 basis points because of an asset mix shift towards higher yielding conventional loans, but then it went down because of lower spreads within alternative single family loans. So we can look at, by spreads, they mean the difference between interest income and interest expense. And we can see a lot of their interest expenses in terms of these percentages here did go up. This one on their deposits went up from 1.57 to 1.87. This one went up slightly. This one pretty much doubled. So their interest expense went up and their interest income as the percentage here didn't go up quite as much. So this kind of makes sense given the rising rates. We've seen the company is recalibrating to a higher level of rates, and as some of their older loans roll off their balance sheet and they get replaced with loans at different rates, then that's going to influence net interest margin. But again, this is something to keep an eye on going forward because you want to make sure it stays consistent. If it starts to decline and decline, then that may spell trouble for the bank and may signal the fact that the demand for their loans isn't quite there and they are facing trouble because they can't secure lenders at the rates they need to in order to continue to be profitable as a bank. Okay, so to summarize basically what I went over in this video, the reason why I think in the short term this company is going to face some headwinds is primarily due to the slowing activity in the real estate market and the fact that with rising interest rates, the loans they offer are now more riskier than they were in the past, which is definitely true. And that could lead to some increasing loan losses and impaired loans in the future. So, like I said, I'm going to continue to monitor that. However, my long term view on the company, talking decades out, also remains true, which is that the factors like immigration policy and also the increasing importance of alternative lending, which is this company's biggest moneymaker, are going to be products that Canadians do need. And especially with the increase in regulations surrounding prime lending, I think that companies like EQB definitely stand to benefit from that changing environment. But anyways, guys, that pretty much does it from this video. So please let me know your thoughts and whether you agree or disagree with me. Again, a big reason why I make these videos is because I want to get alternative viewpoints or other viewpoints from you guys to see if you point out whether you disagree or agree with something I said. I think that's a great part of how you can learn as an investing community. But I hope you did enjoy this video and you found value in it. If you did, then please leave a like and subscribe if you're new to my channel. And I'll see you guys in the next video.